Hey everyone, and welcome. This month, we're going to try to piece together the economic puzzle of October 2025. You know, the headlines are all over the place, but we're going to dive into the hard data to figure out what's really going on behind the scenes, and of course, what it all means for your money.
So, let's just jump right in. The story you've heard all year long is the soft landing, right? This beautiful idea that we can gently tap the brakes on the economy without causing a massive crash. But the latest data? Well, it's starting to tell a very, very different story. You have to wonder, is the market's favorite fairy tale about to end?
All right, let's look past those headlines and get into the numbers. We're starting to see some very real cracks appear in the foundation of the U.S. economy, and it really all starts with the job market.
And this is a really big deal. For months, the entire conversation has been about job growth slowing down. Now, for the first time in a long time, we're talking about an actual contraction. The whole narrative is shifting under our feet.
Here it is. This is the number that got everyone's attention. The ADP report showing a loss of 32,000 private sector jobs. But honestly, that's not even the craziest part. The real story is what they did in the fine print. They quietly revised away over 900,000 jobs from the past year. It turns out the labor market was way weaker for way longer than any of us knew.
So, a weaker job market naturally leads to one thing, right? Weaker consumer spending. And that is exactly what all the real-time data is starting to show us.
This stuff gives us a live look at how people are actually behaving. You can see open table reservations are softening up, credit card spending growth, it's slowing down. And yeah, sure, younger folks are still spending on some things, but just look at air travel, down 6%. People are starting to pull back on those big discretionary purchases.
Okay, so a slowing economy, consumers pulling back. That means inflation should be dropping like a rock, right? Well, not so fast. This is where the story gets really complicated because inflation is proving to be way stickier than anyone hoped. And this quote just nails it. The official target from the Fed is 2% inflation, but the actual math, the real-world numbers just don't add up. As the report says, it's time to stop indulging in the fairy tale and look at the facts.
And to see just how stubborn this is, check this out. This umbrella index is brilliant. It averages out all the major inflation numbers, CPI, PPI, the whole shebang, and what's the combined result? Still running hot at 3.2%. That's not a cool down, that's persistent price pressure that just refuses to quit.
What this creates is this huge gap between the official story and what's happening in reality. You have policymakers telling us, don't worry, everything is on track. But households are really feeling the pain. They're expecting inflation to stay near 4% for the next decade. That's not just an inconvenience, that's inflation fatigue. And it's a powerful economic force.
So this brings us to the biggest head-scratcher of the entire month. You've got a slowing economy, but you've also got sticky inflation. So what does the Federal Reserve do? Well, they send some incredibly confusing and frankly contradictory signals to the market.
I mean, this is the question every single investor is asking. It seems to completely fly in the face of their number one job, which is to fight inflation. Why on earth would you cut rates now, even just a little bit, when inflation is still so far above your target?
Okay, this is where things get really, really strange. The Taylor rule, it's a classic economic formula that kind of tells you where interest rates should be based on inflation and unemployment. Right now, that rule says the Fed funds rate should be over 6%, but the actual rate is 4%, and they just cut it. That is a massive, massive deviation from the historical playbook.
And it's not just about that small rate cut. While everyone was focused on that, the Fed also announced the end of quantitative tightening, or QT. Now, that's a pretty technical term, but it basically means they're going to stop shrinking their balance sheet. By stopping this, they're getting ready to pump more money back into the system. It's a major pivot, a huge policy shift, even if they won't come right out and say it.
So let's put all of these pieces together. We have slowing growth, but we have high inflation. The report we're looking at calls this an inflationary bust. But there's a much more common name for this kind of environment.
And that name is stagflation. It's this nasty, toxic combination that absolutely haunted the economy back in the 1970s. And it requires a very, very different investment strategy than what's worked for the past decade or so.
So how do we know this isn't just some wild theory? Well, there is one key indicator with an almost perfect track record of predicting trouble. And right now, let me tell you, it is flashing bright red.
Just look at this timeline. Every single time the S&P 500 to gold ratio has broken its long-term trend, a major economic event followed. It happened right before the stagflation of the 70s, right before the dot-com bust, and again, right before the COVID crash. And today, it's been broken for 8 straight months. You know, history doesn't always repeat itself, but sometimes it rhymes pretty loud.
So what's the playbook? What do? The strategy here is actually pretty clear. You want to own things, not promises. That means quality companies with strong balance sheets that can pass on rising costs. It means hard assets, gold, silver, commodities, things that hold their value when your currency is being devalued. What you want to avoid are long-term IOUs like government bonds, and of course, cash that loses its purchasing power every single day.
And this isn't just some new idea. If you look back at historical periods of stagflation, especially in the 1970s, the data is crystal clear. Gold, commodities, and high-quality stocks were the asset classes that preserved and actually grew wealth while almost everything else struggled.
So, here's the bottom line. The entire economic environment is shifting right under our feet. The strategies that worked so well for the last decade might not be the ones that work in this new era. All the evidence seems to be pointing to one conclusion. The 1970s playbook is back. And the only question left to ask is your portfolio ready for it?